How you doing? I'm Big D. Thank you for stopping in and spending a few minutes of your day with me. We have to talk about Bitcoin, Ethereum, XRP, crypto in general. This is very important, and I think you're going to want to hear what I have to say. Don't look at this. Just listen. Put the phone down, put it on so you can hear it, and crank it up. Now, Bitcoin is down 45% from its all-time high of $126,000. Ethereum down 62% from its peak. XRP, the token that was supposed to be the great institutional success story of this cycle. The one that finally won its legal battle. The one that launched its own ETF. The one whose CEO stood on the stage at Davos in January and declared that crypto would reach all-time highs in 2026. XRP is down 65% from its cycle high of $3.65. Now, three of the most widely held digital assets on the planet. Three brutal drawdowns happening simultaneously, and not one major financial network is telling you the real reason why all three are falling at the same time, or what it means for every single person watching this video right now. So stay with me, because this is not standard price update. This is a forensic breakdown of the most complex and consequential crypto market event in 2026. And by the end of this, you will understand things that about your portfolio that you absolutely did not understand before you clicked onto this video. Welcome to the wealth management system. No, I'm not anybody that gets paid for this kind of thing, but I do a lot of research. And I think after you watch this to its entirety, you'll see that maybe I have something there. And you take what I give you and use that in your advantage. Could this affect silver and gold? I do believe so. Now, see my disclaimer in the description below. Now, if this is your first time here, this channel does one thing. It gives you macro level analysts that helps you see what the market is doing before the crowd figures it out. Subscribe now and drop a comment telling me where in the world you're watching from. Whether you are in the United States, the UK, Canada, Nigeria, Philippines, South Korea, North Korea. Yeah, North Korea. Maybe they're watching. You never know. Your geography matters here, because as you will see in this video, different parts of the world are experiencing this crypto crash in completely different ways. I want to know where you are. Now let's get into the real story. Let me start with the event that most people missed because it happened on a Thursday. It got buried in the broader chaos, and it tells you more about the structural fragility of this market than almost anything else. On February 5th, 2026, the cryptocurrency market entered its third consecutive session of steep losses. Bitcoin was testing $70,000. Ethereum has already fallen 2600 to, I can't remember exactly, but you know what I'm talking about. At its lowest level since May of 2025, and XRP on that single day crashed more than 16% to, it's just nuts. Now, that made the single worst performing major token in the entire market on that day. Not some random altcoin. XRP is the fifth largest cryptocurrency by market cap, down 16% in 24 hours. Kind of shocking, right? While 775 million in average positions were liquidated across the market. And then, less than 2 weeks later, on February 15th, something strange happened. Brad Garlinghouse, the CEO of Ripple, was appointed to the CFTC's Innovation Advisory Committee. XRP spiked 8% to a nice little level within hours of that announcement. And then, within 24 hours, it gave back every single penny of that gain and crashed 11%. Not good. But something's happening. A spike in a full reversal is in less than a day. And as of right now, February 17, 2026, XRP is trading at approximately $1.50. Down 65% of its cycle high, $3.65, set in July 2025. That consequent spiked reversal flat tells you everything you need to understand about where XRP is right now. And I'm going to come back to this in detail. But first, I need to set the macro stage, because without understanding the broader environment, none of the individual asset stories make complete sense. Here is what most investors think is happening right now. They think this is a standard crypto correction following an overextended bull market. They think the Federal Reserve hawkish stance is creating temporary headwinds. They think the smart move is either to hold tight and wait for the recovery, or the dollar cost average down into assets they believe in. And look at that framework is not entirely wrong, but is dangerously incomplete, because what is actually happening in this market right now is not one thing. It is 5 things happening simultaneously, compounding each other in ways that the mainstream narrative is not connecting. But here's where the most investors are missing. And this is the part where I need your full attention. On January 30th, 2026, President Trump nominated Kevin Walsh as the next chair of the Federal Reserve, replacing Jerome Powell when his term ends in May. And the market's reaction was immediate and violent. Bitcoin fell from approximately 88,000 to around 81,000 in a single session. ETFs blend nearly $1 billion in outflows on that single day, and it cascaded that followed over the next 2 weeks, produced the February 1st liquidation event. 2.58 billion wiped out in a single 24-hour window. One person lost $222 million on a single Ethereum position in one trade on one day. Now, Kevin Walsh is not a simple villain in this story. He has publicly said that Bitcoin, quote, exposes policy errors and could serve as a legitimate alternative story or store value. Michael Saylor himself called him the first pro-Bitcoin Fed chair. And Walsh has real investments in the crypto infrastructure space. So the picture is, I'd say, clear. But what the market heard on January 13th was not nuance. What the market heard was this. A historical hawkish economist who resigned from the Federal Reserve in 2011 rather than support quantitative easing is about to take control of the world's most powerful central bank. And the immediate implications of that in a market running on average, on a leverage, on liquidation expectation. Now, Kevin Walsh, the Fed, in the liquidity bomb, and on the assumption that rate cuts were coming was catastrophic. Stay with me, because the next part changes everything about how you should interpret what you're seeing right now. The Federal Reserve held rates steady at its January 18th meeting, keeping the federal fund rate in a range of 3.5 to 3.75%. The December dot plot, the Fed's own projection, showed only one rate cut expected for all of 2026. Only one. And at the DXY, the United States dollar index, pushed higher on the back of the hawkish signals. When the dollar strengthens, it creates a tightening effect across every global risk asset. simultaneously. Capital flows back to the safety of the dollar dominated instruments. Money market funds currently hold approximately 7 trillion because more attractive relative to any volatility. And crypto, which is the most globally accessible risk on asset that exists, takes the hit first and hardest. This is where it gets concerning. And I want to be precise because the number matters enormously. Bitcoin's ETFs, the product that was supposed to be the defining instrumental on-ramp of the entire cycle, set net outflows of 6.81 billion over the 3 months from November 25th to January 2026. The longest sustainable outflows streak since those produced launch in January 2024. Total Bitcoin ETF assets under management fell from a peak of approximately 137 billion to around 97 billion. And Bitcoin market depth, the ability of the order book to absorb large sell orders without dramatic price movement, declined approximately 30% from the October 2025 peak. When you take declining market depth, elevated open interest, macro triggered like the wars nomination, the result is not a gentle correction. The result is the February 1st liquidation cascade, and that cascade set the tone of everything that follows. Let's talk about the Ethereum specifically, because what is happening with the ETF or ETH is both related to the Bitcoin and also driven by its own structural pressures that have nothing to do with the Fed. Ethereum's all-time high this cycle was approximately $4,946. As of February 2026, it has fallen to a low of $1,746, a crash of more than 62% from the peak. ETH was the worst performance in the February 1st liquidation event, with 1.15 billion in Ethereum positions alone being forcibly closed. And the ETH ACE to BTC ratio, the measure of Ethereum, its relatively strength against Bitcoin, and has been in a sustained downtrend that goes beyond the macro environment alone can't explain. Here's what's really happening with Ethereum. The original bull thesis of ETH centered on it being the dominant base layer for decentralized finance NFTs, my apologies, and the broader Web3 economy. The more activity on Ethereum, the more ETH gets burned without its free mechanism. The more defiant, more pressure supports the price. That was the story, and it was a compelling story in 2021. But the crypto ecosystem has evolved dramatically since then. Layer 2 scaling solutions, Arbitrum, Optimism, Base, and other built on top of Ethereum have absorbed an enormous share of the activity that would have generated fees on Ethereum's mainnet. This is architecturally good for the ecosystem, but it creates a genuine question about ETH and asset, because of if transactions are happening on a base instead of Ethereum mainnet. The fee burn that supports ETH's value doesn't happen at the same scale. At the same time, Ethereum's staking yield, the return you earn for locking up the ETH to secure the network, sits at approximately 3 to 4% annually, compared to the 5% available in U.S. short-term treasuries with essentially zero risk. And the risk-adjusted math for institutional portfolio managers becomes challenging. This is not a fatal problem, but it is a real drag on the marginal institutional buyer in a high rate environment. And combined with a broader macro pressure, it explains why Ethereum dropped harder than Bitcoin and why the Ethereum BTC ratio continues to compress. You need to understand this before I show you what happens next. Let's get to XRP, because this is where this story gets genuinely complex and where most commentary you have seen has been dangerously superficial. My opinion. Again, I'm not a professional. See my disclaimer in the description below. XRP hit its cycle high of $3.65 in January 2025. That rally was driven by two things. First, the SEC lawsuit against Ripple, which had hung over the token like a cloud for years, finally reached a settlement agreement in August 2025. The regulatory uncertainty that has suppressed institutional interest in XRP for half a decade has officially behind it. Finally. Second spot, XRP's ETFs launched November 2025 and pulled it in over 1.3 billion net inflows within their first month of trading, with no single day of outflows in that initial window. For context, Bitcoin's ETF saw net outflows during the same period. XRP ETFs were attracting capital while Bitcoin's ETFs were bleeding it. On the surface, this setup should have been a powerful foundation for a continued rally. Legal clarity, ETF launch, institutional inflows, CEO on a Davos stage in January 2026, saying crypto would reach all-time highs. Everything in the fundamental story pointed up, and yet the price went down 65%. Comment below if you think XRP's fundamental story is disconnected from its price action right now, because this exact disconnect is the most important question facing XRP's investors in 2026. Here's why the fundamental story and the price story are telling a completely opposite thing right now. And this is the part that challenges how you understand not just XRP, but every asset in this market. XRP's price is driven in the near term almost entirely by position and momentum rather than fundamentals. One analyst at CoinDesk put it exactly this way after the February 5th crash, and I think it is the most honest description of XRP's situation. XRP is trading like a leverage unwind disguised as a fundamental story. That sentence deserved to be read twice, because what it means is that the positive fundamental developments, the lawsuit settlement, the ETF launch, the institutional partnership created the narrative that attracts leveraged long positions. And then those positions become too large relative to the available liquidity. The market doesn't wait for the fundamentals to play out. It forces the leverage out violently, and the price crashes regardless of what the underlying story says. The evidence for this is in the funding rate data. XRP's funding rate on Binance, which measures the cost of holding a leveraged long position, dropped to negative 0.028% in mid-February. But this is a 10-month low. The last time XRP funding rates were this negative was back in April 2025. And that happened next. And what happened next in April 2025, the funding signal came first. Then the SEC settlement announced, landing in May, and XRP rallied 82% from approximately 160 to 365 by July. The shorts got squeezed. The longs who held through the pain made extraordinary returns. Now, and I want to be careful because here's the analogy, and it's not perfect. Today's setup has both more tailwinds and more headwinds than April 2025 did. The tailwinds, the SEC lawsuit is fully resolved, removing the legal overhang entirely. XRP's ETFs are live and have accumulated over 1.3 billion in net inflows. Ripple spent 2.5 billion on acquisitions in 2025, including the 1.25 billion hidden road deal. Building serious institutional infrastructures. Brad Garlinghouse has just been appointed to the CFTC's Innovation Advisory Committee, giving Ripple direct access to the regulatory conversation that will shape crypto's future. Standard head of digital assets research, Jeffrey Kendrick, has an $8 year-end price target. That could be pretty decent. Now that's for XRP. A 430% gain from the current level. Japan's financial system through the Mizuho Bank and the SMBC Nikko-backed Financial Infrastructure Innovation Program is actively building on the XRP's ledger. The headwinds Bitcoin is sitting near 60,000 in an environment where the fear and greed index hit extreme fear. The Fed's Warsh nomination has injected real uncertainty about the liquidity, the conditions that historically power altcoin rallies. Unlike April 2025, when traders could reasonably hope for a Fed pivot, there is no clear liquidity catalyst on the near-term horizon. And XRP's own structural issues. The fact that banks using Ripple payments don't have to hold XRP, and the fact that Ripple's own RLUSD stablecoin competes with XRP for payment utility raised legitimate questions about the depth of the organic demand for the token versus speculative demand. Motley Fool published an analyst on February 11th suggesting XRP could fall to $1 or below during 2026. Standard character easy model hit it at $8 by year end. $8 by year end. I've already said that, but still I have to say it again. It's amazing. If it could. This is not a modest disagreement. That's a 700% gap between the bull and bear case. And that gap tells you everything you need to know about the genuine uncertainty surrounding XRP right now. Hit like if you think XRP funding rate signals a negative 0.028%, a 10-month low in the setup for the next major squeeze higher. And let me also know in the comments where you think XRP ends in 2026, because this is one of the most polarizing debates in crypto right now. Now I want to connect all three of these assets, Bitcoin, Ethereum, and XRP, and to the signal macro force that is shaping all of them simultaneously, because the individual asset story matters, but they all flow from the same source, and that source is global liquidity. Global liquidity, the total amount of the money circulating through the financial system across all central banks, across all credit channels, has a measurable and historical consistent relationship with crypto prices. When the global liquidity expands, crypto rises, and when it contracts, crypto falls. This relationship is not perfect. It has led and lag times. But over 6 to 12 month period, it is the single most reliable macro signal for micro market direction that exists. So where is global liquidity right now? It is under pressure from multiple directions simultaneously. The Fed is holding rates at 3.5 to 3.75%, and the White House nomination has raised the real possibility of a more aggressive balance sheet reduction that markets were pricing. The Bank of Japan is still navigating the most delicate monetary policy transition in decades, slowly trying to exit it ultra loose policy without triggering a yen crisis or a Japanese government bond market implosion. The yen carries trade where global investors borrow in cheap yen to fund investments in higher yielding assets like crypto is under pressure every time the DOJ moves toward normalization. It is Sunday morning. And we have seen how violent that carry trade can unwind. Europe is cutting, China is cutting, but their easing cannot fully offset what the world's largest central bank is doing by holding rates elevated. And here's the part that most crypto investors have never connected before. Look at what's happening in South Korea during the February crash. XRP was the most traded cryptocurrency in South Korea during the peak selling session, with 24-hour trading volumes of 1.2 billion, uptick in BitM alone. That was higher than Bitcoin's Korean volume of 285 million, Ethereum's 304 million, and that exchanges. Why is that relevant? Because South Korea is one of the world's most active retail crypto markets with a passionate and highly leveraged retail base. When Korea retail traders are generating more XRP volume than Bitcoin, Ethereum combined, and the volume is heavy weighted towards the sell side, it tells you that the selling pressure is not coming from sophisticated institutional holders executing older risk reduction. It is coming from retail traders being stopped out of leveraged positions in one of the most emotionally volatile markets in the world. And when that happens at scale, the price impact is amplified dramatically. This is where it gets concerning on a level that most people are still not appreciating. The total crypto market cap has fallen from 4.38 trillion in October 2025 to 2.3 trillion, roughly 2.3 trillion in February 2026. $2 trillion wipeout in under 4 months. For perspective, the entire U.S. subprime mortgage market that triggered the 2008 financial crisis was about 1.3 trillion. We'd have erased more value in crypto in 4 months than the size of the market that nearly destabilized the global financial system. Now, crypto losses are not the same as systemic banking risks. Digital assets aren't embedded into bank lateral structures the way mortgages were. But wealth destruction at that scale still has consequences. In effect, consumer spending in crypto-heavy economies, if slow ventures capital deployment into blockchain, it makes institutional boards more cautious about approving new allocations. These second-order effects take months to appear in the data. By the time they do, most retail investors have already reacted emotionally. So this is not just another reaction or correction. My apologies. The scale is different. The macro backdrop is different. Let's talk about what happens next. Everything we've covered, the worst nomination, ETF outflows, 258 billion liquidity event, XRP's leverage unwind, dollar strength, yen carrying pressure. Tightening global liquidity feeds into 3 realistic scenarios for the next 3 to 6 months. And you need to know which one your positioning is built for. Well, scenario 1, the patient base. Bitcoin holds $60,000 as a structural floor. February 1st liquidation flushed 2.8 billion in forced selling. That kind of leverage purge doesn't resolve in days. It resolves in weeks. Market consolidation. Frustration builds. Sentiment stays fragile. ETF outflows stabilize. BlackRock's IBIT, which continues attracting inflows even on heavy redemption elsewhere, anchors institutional confidence. Ethereum begins stabilizing as the layer 2 ecosystem matures and free dynamics now normalize. XRP has, with negative funding rates, gradually set up for short squeeze similar to April and May of 2025 as over-leveraged shorts unwind. In this scenario, even aggressive long-term projections like standard chartered's high XRP targets stop looking unrealistic and start looking like positioning math meeting improving macro conditions. This doesn't feel like the bull market. It feels like a slow repair that eventually turns into momentum. Scenario 2, the macro deterioration extension $60,000 fails. Kevin Walsh's confirmation brings a hawkish surprise, possibly faster balance sheets reduction, or rhetoric that market interprets as a rate hike returning. The dollar strengthens, liquidity tightens further. Bitcoin drops towards $50,000. Ethereum declines harder without a strong narrative catalyst. XRP faces its more extreme downside projections, including the possibility of a move towards $1 or even lower. Technical levels of momentum fully unwind. This scenario is brutal, but historically, the investors who accumulate more during maximum stress without leverage with multi-year conviction are the ones who define the next cycle's outperformance. The difference isn't courage, it's preparation. Scenario 3, the worst surprise and the great rotation. This is a scenario market at least prepared for. Worst takes the Fed chair seat, proves more than expected. Economic data softens, inflation cools, growth concerns risks or rise. The signals a faster path to rate cuts than the market priced in. The dollar weakens, liquidity conditions ease. Then regulatory clarity advances in Washington. That's what I'm waiting for, the Clarity Act. The crypto market structures framework progresses, reducing institutional uncertainty. In that environment, Bitcoin benefits from improving liquidity and potential reallocation from the $7 trillion sitting in the U.S. market, money market funds. Ethereum benefits as layer 2 maturity begins translating into sustainable value capture. XRP benefits from regulatory clarity and accelerating ETF flows, building on the capital already allocated. All 3 rise, but from 4 different reasons. And that's the key. 3 assets, 3 thesis. Bitcoin is primarily a macro monetary asset driven by liquidity, dollar strength, and fixed supply versus expanding money. Ethereum is primarily a technology platform asset driven by ecosystem value and network economics. XRP is primarily a financial infrastructure and positioning assets driven by institutional adoption of derivatives market dynamics. 3 assets, 3 frameworks, yet most retail investors treat them as one signal crypto trade. If you have one, most likely you have others if you're very serious in crypto. That's the way I see it, and that's how, when I talk to different people, that's how they see it. That conflation is where crypto gets destroyed. So as this year ends, don't ask what will price do next. Ask, do I know exactly what I own each asset? Why I own each asset? And is that reason still intact? If you own Bitcoin for the macro thesis, short-term volatility is noise. If you own Ethereum for the technology thesis, you need to honestly revalue how layer 2 evolution impacts value capture. And if you own XRP for the institutional payment thesis, you need to understand which regulatory and adoption assumptions your conviction depends on and what would invalidate them. In markets, this interconnects. A macro-driven survival doesn't go to the most confident voices. It goes to investors that with the most clarity and the most discipline. The data tells the story. The macro tells a story. The positioning tells a story, but the story isn't finished. The next chapter could be written in a Fed press conference. And where it goes depends on part of what you do right now. If you want to stay ahead of those shifts, not reacting emotionally, but understanding the structure forces underneath them, I mean, it's exactly what we focused on at a wealth continuum. Not noise, not hype, depth when it matters. So I want to say thank you for stopping in and making it all the way to the end. My appreciation, I am being very humble, but I am very appreciative for each and every one of you that have stopped in and listened to what I have to say. Please stay safe, and God bless you and your families. Have a great rest of your day.